Good afternoon. This is Tom Alexander. It is Sunday, March 20th. It is 1:12 p.m. Eastern Time in beautiful Charleston, South Carolina. And this is the weekly report. This is the video version of the written report. A couple of housekeeping things. If you are new and seeing this on YouTube for the first time, would very, very much appreciate it if you would subscribe to my channel. For your convenience, you may want to hit the alert bell so that you know when I post something new. And if you find value in these reports, if you would like them, that would be very helpful as well. I would appreciate that. Okay, let's talk about the market. The big question is, are we in a bull market or a bear market? I don't know, and I don't think anyone else does either. What I try to do as a trader, and I define trading as one who trades from intraday to several months out into the future, somewhere in that time frame. You can know what's going on. You can have strategy and tactics for trading one time frame. And at times, you really don't know what's going on, or there's not a good reward to risk using the methodology that you use to evaluate and analyze markets for another time frame. And we are at one of those junctures now, from my perspective, as far as anything longer than really intraday is concerned. Now, we have potentially put in important lows that could lead to new all-time highs in one or more of the primary U.S. trading indices that you see on my screen here. I think we will have some evidence of that maybe by Wednesday. And we had this furious rally from Monday's close into Friday's high. We had several drivers of that exogenous events. We have the ongoing situation in Ukraine, certainly a driver. We had the FOMC, and then we had option expiration on Friday, and we really won't know the full effects of that expiration until probably Monday's close. But there are signs here that a bottom could be in place. There are levels above us that have to be exceeded to increase that probability. I have put the levels in the report. I'll go through each of the indices one by one, and we'll talk about it a little bit. Okay, let's talk about the levels here. I'm going to take each index one by one. 4,600 area is important. And as I have mentioned before, there is a guideline when you're in a strong trend, up or down, that the previous day's extreme or the second day back extreme should hold. Initiative moves under auction market concepts, we know that they should be pretty relentless. The retracements against the primary trend should be relatively shallow and short-lived. And the SPX, the two-day back low, is 43.36. So you can see we're sort of in the middle of nowhere in my mind in terms of a longer-term, high-probability trade idea. And let's look at the NDX. The NDX, the levels to the upside are up here around 15,100, give or take 75 handles. To the downside, 13,823, whatever Thursday's low was. I don't know if that's the exact low of Thursday, but whatever Thursday's cash low. These levels, if we get some sort of retracement early in the week, these are the levels to be keeping an eye on that really shouldn't be exceeded. And here's the Dow, here's Thursday's low. This is the upper key reference area. And then to me right now, the most important contract for the intermediate term is the Russell. Here is Thursday's low. Now, two things about Thursday's low in the Russell. If we close below Thursday's low, from an auction market perspective, it immediately opens up and begins to make it dramatically increase the probabilities that we're going to see lower lows down here below these February lows. Or was that late January? Okay, late January, early February lows. On the other hand, if the Russell is able to continue to show strength and it closes above this February 10th high, what it will be doing, it will be closing above this level from where the Russell really broke down. So this is a critically important contract to watch for all the indices, for the health of the bull market. It's in a balance area. It's going to move sharply out of this area eventually. It's approaching an upper key reference area. So we shall see. Other part of the report, let me go back up here, look at the report. Okay, I talked about the development of the market using the profile graph last week, and I encourage you to click on the links. You know, if you want to go back and see what I said in a previous report, I post several weeks reports at the very beginning of each weekly new report. It's a great learning tool. You can see what I say, why I said it, and then you can go back and you can see how it turned out. And over time, you will begin to understand how to use these auction market concepts, and you will also begin to develop the confidence and see the incredible robustness of these concepts. You know, I don't like to predict things, but there is nothing more predictive than understanding auction market concepts. And, you know, a week ago, I suggested this was a bullish case for this market. Now, I had a bearish case outlined as well that would have taken development lower, but the bullish case played out. All right, let's take a look at the internal part of this equation. And here's breadth. Now, breadth is acting well under a bullish case. What I mean by that is, you know, if we're in a bull trend, this is what you should see. You should see breadth be positive relentlessly. And when it gets negative, it doesn't affect price dramatically. For instance, if breadth this week, early in the week, if we have some sort of retracement and breadth gets negative 15 to 2,000, but we hold Thursday's low, that would be a very positive sign. Now, it's going to get interesting if the market continues higher, because breadth is going to get more and more extreme taking a look at the 5-day moving average, the 10-day moving averages. But in bull trends, that's normal. You will have these divergences between price and breadth that drag on and on and on and on in a bull trend. That's what you expect to see. What we have been in is a bear trend or a pretty healthy correction within a bull trend. And in situations of that market condition, the price breadth relationship will behave differently. I talked about this in the report last week, but basically what happens is that breadth will reach an upper extreme, and then the market will very quickly form a top. You'll go to lower lows, and each time breadth tries to bring the market higher, it rolls over. And basically what it's telling you is that it's short covering as opposed to new buying. So last week was a pretty healthy sustained rally. Let's see if it sustains itself this week. And I will keep you updated. Hope you guys have a wonderful weekend. Have a great week trading.